Hey guys, Katie Day with Coldwell Banker here with Joanne Cooper with First Nationwide Mortgage, talking today about different loan and down payment options. A lot of people think that you need 20% down when you're purchasing a home for a down payment. Tell me about different options that they may have.
Actually, there's lots of options, Katie. It is a myth that you have to have 20% down. I hear that a lot, so I'm glad to have the opportunity to clarify that a little bit. You can actually get in, if you're a veteran, you can get in with zero money down. If you're not, anybody can take advantage of an FHA program that requires as little as 3.5% down. And the funny thing is that a lot of times the rate on that FHA program, even with mortgage insurance, comes out less than your 20% down rate, because without mortgage insurance, the lender has more risk. And so they're going to show that in the rate. So a lot of times it's just really not the best option. The determining factor is going to be different for everybody. If you've just got tons of money and you just want to put it in there, that's fine. Does that sound
don't be with me, I'll have that problem, right? I have too much money.
Well, you know, there are people that just don't mind at all, but if it's going to be wiping you out to where you then have nothing on reserve, it really isn't a wise thing. Or if you have a lot of other debt. For instance, there are people now that on average can carry $50,000 or $60,000 worth of debt. Car payments, student loans, credit cards, you name it. IRS debt, anything like that. $50,000 worth of debt can equal $1,500 or $2,000 a month. But if you put that $50,000 in your house payment, it might only be $150 or $200 a month. So it makes sense to use your money wisely, get rid of that other debt before throwing it into your house.
Makes sense. Well, the FHA program sounds great. What type of credit score are you generally going to need to qualify for a loan with a 3.5% down payment?
You know, that's actually another really cool thing about it. With conventional, you can get a loan when you're in the low 600s, but your rate is going to start in one area and get better as your score gets higher. FHA is not so hard on you when it comes to your credit score or debt ratio. It's much more lenient. So, you know, to get the optimal FHA rates, you only really need to be in that 620 to 640 range.
Okay.
You can even do it lower, but your your interest rate is going to go up a bit as your score gets lower than that. But overall, still really great rates. Debt ratios are allowed, you know, up into the mid 50s, whereas conventional caps at about 45 to 50. So it really is a great option for a lot of people trying to get in, especially to their first home.
Yeah, definitely. And when you say debt ratio, to help explain that to someone that may not be familiar with it, it's a term we probably use on a frequent basis.
Sure.
What do you mean by that?
What we do is we look at how much your gross income is on a monthly basis and how much your mandatory debt is. And when I say mandatory debt, I mean you may have a credit card that only requires $25 a month to be paid, but you may pay $200 a month. We only have to count the 25 in your debt ratio. So we look at all of your combined debt versus your income and come up with a percentage. So basically they don't want your debt to be more than about 50% of your income.
Makes sense. All right, well, thank you so much for sharing your knowledge, and I'm definitely excited to talk more and
awesome.
You know, share more info on loans. And
it was my pleasure. Any of your clients that have questions, just send them on.
Sounds good.
All right.
Joanne's info will be on the bottom of the screen here at the end of the video, so you guys can contact her if you have any loan needs or questions. She'd be happy to help.